success so high. I will achieve, I will fly high. INDI in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
In a surprise move last week, the Reserve Bank of India announced its decision to revise the policy rate by 40 basis points. The cash reserve ratio was raised by 50 basis points. The move is expected to take out excess liquidity to the tune of over 87,000 crore rupees from the market. As the economy prepares for a spate of rate increases, such decisions will have a far greater implication for banks, insurance, and the financial industry. Good morning, my name is Ishan Gera, and you're watching the Business Standard Banking Show. In this episode, we look at the highlights of significant events from the past week. We also have an interview lined up with Vaidyanathan, MD and CEO of IDFC First. In the Banking for You section today, we explain the pass-through of the repo hike on loan interest rates. In this week's Take 2 section, we speak to Rupa Rege Nitsure, Group Chief Economist, L&T Finance, on why a rate hike was inevitable. Here's a look at the developments of the week. Life Insurance Corporation's public offering is expected to give the government some hope for future listings. The issue closed on May 9th with nearly 3 times the subscription. The foreign participation, however, has been muted. The finalization of allotment is to take place today, and the issue is to be listed on May 17th. LIC had fixed a price band of 902 to 949 rupees per share. Media reports hinted that the government might privatize one of its general insurance companies later this year. Sources also said that the state-run general insurers, National Insurance Company Limited, Oriental Insurance Company, and United India Insurance may receive a capital infusion of 3,000 to 5,000 crore rupees. LIC's share sale has got a fillip, but sadly that is not the case for Rupee. On May 9th, the currency depreciated by 51 paisa to its lowest levels against the dollar. This was lower even than the March low of 76.98 rupees. As the return of safe haven assets is hurting emerging markets, not just the rupee but also the forex reserves have dipped. India's reserves fell from $642 billion last year to under $600 billion last week. If the RBI steps in to prevent a steep correction, these will drop further. Talking of the RBI steps, Apple announced it had stopped accepting credit and debit card payments for subscriptions and app purchases using Apple ID in India. The Cupertino giant took this step in view of RBI's new rules on auto debit mandates and card tokenization. Apple has been pushing its users to pay using its wallet, UPI, and net banking. The central bank has set deadline for companies of June 30th to purge all saved card data. Paytm earlier this week announced that it had tokenized 28 million cards and would purge data ahead of the RBI set deadline. After payments, let's now move on to a small finance bank. RBI last week gave its no objection to the merger of Equitas Small Finance Bank and Equitas Holdings. Equitas Holdings would have to divest shareholding in Equitas Technologies and seek RBI approval for bringing Equitas Development Initiatives Trust and Equitas Healthcare Foundation (EHF) under its ambit. The merger will help Equitas reduce promoter stake to less than 40%, a condition set by RBI for all SFBs 5 years after commencement of operations. Equitas SFB had posted a profit of 120 crore rupees in the fourth quarter of the financial year. Just a year before the RBI granted 21 license to small finance banks and payment banks, 2 entities were given a universal banking license. IDFC, which had secured a universal banking license, merged with Capital First and NBFC in 2018 to form IDFC First. The bank has come a long way since. In an interview with a banking editor Manojit Saha, IDFC First MD and CEO, V. Vaidyanathan discusses the journey and the recently announced results.
Welcome to the Business Standard Banking Show. IDFC First Bank reported a strong profit growth in the fourth quarter recently. The profit grew by 168% to about 342 crore. To speak more about the bank's strategies and plans going ahead, we have Mr. Vaidyanathan, MD and CEO of IDFC First Bank. Mr. Vaidyanathan, welcome to the show. First, to talk about while announcing the Q4 results on Saturday, the bank has said that in the first 3 years, the bank tried to increase its retail deposit base while slowing down on loan growth. Now, yes, now the bank is set to take off the loan growth and planning a loan growth of 20 to 25% over the next 3 years. What could be your strategy on the loan growth? Which are the sectors this loan growth will come from? Since you are already said that since the bank's focus is to be a retail focused bank.
See, currently our loan book composition is as follows. Our 38% of our loan book today is basically either home loans or loan against property, which is basically property covered. Consumer loans is 18%, vehicles is 12%, and SME loans is 12%. We feel that, so this is the broad breakup of our retail book to your question. Now, we feel that each of these businesses, whether it's consumer loans or wheels or SME or home loans or loan against property, everything will grow in this country. So really for us to grow 20-25% on home loans or other businesses is really no problem at all. In fact, we'll be launching new businesses also during the next 2 or 3 years.
Which are the new business you plan to enter in the next 2 to 3 years?
We just launched our gold loan business. We see a really big potential because we have a large number of branches now. So gold loans can be given from our branches. We expect strong growth there. The other business we are launching is we are scaling up, let me say, is the wealth management business. We want to scale up our commercial vehicle business. It gives us priority sector requirements also. We want to scale up really many. We are doing very well in the cash management business. We're doing extremely well in the fast tag business. Our regular businesses also, these home loans and car loans, everything will scale.
In December 2018, when Capital First merged with IDFC Bank, you said that the medium-term roadmap, that is over 5 years, you will increase your retail loan book to 70%. Have you already achieved the journey, achieved the target?
The way we are looking at it right now is that we have launched so many businesses, the vehicles business, car loans business, home loan business, loan against property, so many of them. The way we're thinking is that none of the businesses for the bank should exceed 15%, except home loans and loan against property, where we want to, where we have kept the upper cap at 20%. So, and of course, corporate. So basically, we want to be a very, very diversified bank.
Also, one of the very interesting thing which came out from your fourth quarter result is that your CASA has now reached almost 50%. Do you think this kind of high CASA is sustainable going ahead?
See, last year our CASA grew very strongly from, in FY21, our average CASA during the year was about 42%. During FY21. During FY22, our average CASA rate was close to 50%. So that's a very strong growth. We feel that this will definitely be sustained by us, or probably even grown between 23, 24, and 25. We want to be a 50% CASA bank, and we have a strong inflow of deposits on savings account and current accounts in the bank.
Linked to CASA is your net interest margin. The net interest margin for the financial year 2022 was about 5.96%. That's one of the highest among Indian banks, I think. Again, do you think that kind of margins are sustainable? You can hold on to those margins?
Our main reason for the NIM expanding so much is that our CASA percentage increased. Because earlier, these monies were from a wholesale deposits, or they were from legacy borrowings, which was at 8.8%. Now we are repricing the same 8.8% to as low as 4.8%. So that amount is straight away coming through the net interest margin line. So the main reason is that. The number two reason is that last year cost of funds also came down quite sharply. So that also is resulted in a big improvement in net interest margin. So we feel that our business is well structured, and for us, this kind of net interest margin permits us to make the necessary investments in building the bank for the future.
Again, in December 2018, when this merger took place, you talked about a cost-income ratio of reaching 55%, which was 80% at that point in time. I think as of last quarter, the cost-income ratio is somewhere around 76%. So, I mean, do you think you will be able to achieve the cost-income ratio of 55% by the end of the 5-year period from merger?
See, that's how whenever any business is set up, that's how cost-income behaves. Because in the initial stage, when you set up a bank, there is very little income, but you're setting up branches, ATMs, all the people, everything comes. In fact, pre-merger, for the half year of FY 19, pre-merger half year, the cost-income ratio of the bank was 92%. Now, after that, every year it's been coming down. Last to last year it was 83, 84%. This year it's come down to 70, mid 70s. Next year it will come down further. So cost income ratio will keep coming down for the bank. There are 3 reasons why cost income was high. For example, we even today. Let me say there are 3 reasons why cost income will further come down, and these are as follows. Today also, we have 25,000 crores of legacy borrowings, which we're paying 8.7% today. When we replace them with the current cost of money, about 4% lesser, that will straight away add to the income line. So the cost to income will get better. The other reason is credit card business. In the credit card business, we have high cost income in excess of 130, 140%. But we are very sure credit card will become profitable, and that will straight away reduce the cost income in the next 3 years. And third is also that set up a branch, etc. will start selling many other products from the branches. So we are very confident there is a glide path. Cost income will come down in the bank.
In the last 4 quarters, we have seen improvement in asset quality, both in terms of net NPA and gross NPA. But now, as the RBI's the one-time restructuring scheme, which was announced during COVID period, will come down, will come to an end by, say, September, October. How do you think the asset quality will shape up?
When we look at asset quality, there are 3 or 4 things to look at. One is gross NPA. Our gross NPA has already come down from 4.01% in March 2021 to 2.63% as of March 2022 on the retail side. That's a big drop. On the net NPA front, again, it has come down from 1.9% as of March 21, 31st March 21, to it has come down to 1.1% as of 31st March 2022. Our SMA, which is the pre-NPA stage, 1 to 90 days overdue, that bucket is also shrinking quite sharply for us. The fourth thing is slippage. Again, on that front, the retail slippages are coming down every quarter. Number 5 is recoveries. Again, recoveries are increasing since the last 4 quarters at a stretch. So every indicator we are seeing, we are finding that the asset quality is getting better and better. So we feel that next year our retail NPA should come down to below 2% gross, and net NPA of retail should come down to below 1%, maybe about 0.7% or 0.8%. So this trend is very clear for the bank. I believe that our bank is set for a very solid performance over the next few years. Very simple reason that the first 3 years we were not growing the loan book much because we had liability side challenges to address. But that is all sorted. Our biggest thing that you should now in the bank, we have addressed the asset side issues, we have addressed liability side issues, we have addressed everything. Only one thing we have to grow is profitability. And this year onwards, you will begin to see the profits rise. Last year, our operating profit grew by 44%. We expect that next year as well, and the year after that, we believe that sort of track can be maintained. You can watch the results to to get more confidence.
Profitability remains a concern for most new banking entities. After addressing the challenges on the liability side in the past 3 years, IDFC First Bank is set to improve its profitability as it gears up to grow its loan book by 20 to 25% for the next 3 years, Vaidyanathan says. Meanwhile, the rate hike by RBI is bringing its own challenges. The cost of funds for lenders has increased, so there is expected to be a pass-through for borrowers. In today's Banking for You section, our experts explain how rates will get passed on to consumers and what terms like EBLR mean.
The Monetary Policy Committee of Reserve Bank of India increased the repo rate by 40 bps to 4.4%. Repo rate, or the policy rate, is the key interest rate for the economy, which is decided by a 6-member committee known as Monetary Policy Committee. It is expected if the repo rate is changed, then the interest rates for home loans, car loans, etc. will also change. So does RBI's repo rate hike this time translate to an increase in interest rates on loans? The short answer to the question is yes. ICICI Bank, Bank of Baroda, and some other banks have increased interest rates on loans after the RBI decision. There are two dominant loan rate regimes in the country at this point in time: marginal cost of funds based lending rate and external benchmark based lending rate. The main objective of the loan pricing regimes is to make interest rates sensitive to changes in policy rate. The MCLR regime came into force on April 1, 2016. As the name suggests, MCLR is linked to the marginal cost of funds of banks. 53.1% of the loans of commercial banks are linked to MCLR as on December 2021. Banks have started increasing their MCLR even before RBI increased the repo rate, because interest rates in the economy are going up, so was their marginal cost of funds. Now with the repo rate increase, MCLR-linked loans will further go up. Another new loan pricing regime was introduced on October 1, 2019, known as external benchmark-based lending. Banks were asked to link all floating rate personal or retail loans and loans to micro and small enterprises to external benchmarks from October 1, 2019. 39.2% of the loans of commercial banks are linked to external benchmarks. For most banks, the external benchmark is the repo rate. Now that the repo rate is hiked, lending rates linked to repo rate have started to go up by at least 40 bps. Banks add the spread over the external benchmarks. So, if the repo rate is 4.4%, the home loan rate will be like 6.9%. The difference is the spread. One point to remember: the loan rate regimes are only applicable for commercial banks and not for non-banking finance companies like HDFC Limited or Bajaj Finance. There is no RBI mandate loan pricing regime for NBFCs.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Rate hikes will certainly have an impact on the common man as his expenses will rise. Also, with the rate reversal taking place, the situation is not too favorable for NBFCs or the economy. I had a quick chat with Rupa Rege Nitsure, Group Chief Economist, L&T Finance, after the RBI's rate hike. Hi Rupa, thanks for coming on the show. The RBI on Wednesday announced a 40 basis point revision to rates. How much more leeway do you think RBI has to tighten the policy?
See, RBI will now stay in a data-driven mode. Though many people describe this as a surprise move, it was not at all a surprise move for us, at least for me, because you see they had started signaling from April policy onwards, when for the first time they introduced this standing deposit facility and kept the SDF rate also at a level which was 40 bips higher than the reverse repo rate. So, and governor in his press meet had very clearly said that henceforth they are going to prioritize inflation. So actually this action which came out of the policy cycle, you have to look at it as a cumulative action where you have to add these 40 bips to earlier 40 bips, which makes it 80 bips, plus CRR hike of 0.5%, which directly has sucked out more than 87,000 crore of surplus liquidity from the banking system. So point is that his action is quite aggressive and taken at the right time, though they have been saying that they have taken it to control inflation. I think this kind of sudden action was warranted because of too much of volatility in the forex market, and Central Monetary Authority also has to safeguard the value of currency. So that explains it more than anything else.
Now, when we're talking about this, the economic situation in the country is not too encouraging. Don't you think being too aggressive may further push India towards deceleration?
Well, this debate is going on for years, that when, inflation is originating from supply side, how can Reserve Bank of India's actions be effective, this and that. I think many times RBI governors and think tanks within RBI have explained it very well, that whatever is the origin of the inflation, once the inflation starts rising, sooner than later it gets generalized, because we have a big organized sector where wages and salaries of people are linked to consumer price inflation. So, they get revisions in their wages and salaries automatically. And when they get higher income, it is not necessary that they will spend it only on food items or fuel items. They will spend it on variety of items. So it leads to generalized rise in prices. So it is the duty of central banks, not just in India, world over, to control prices, because inflation actually leads to inequality. In the interest of financial stability, in the interest of protecting equity, Reserve Bank of India has to move towards inflation management.
Now, when we talk about this, it's very interesting, because when I circle back to the rates, one of the questions that troubles me a lot is that RBI also said inflation is largely influenced by global factors. And you've just answered this in part. How limited could the impact of a repo rate hike be on prices if it's mostly influenced by global factors?
Well, that's what I said. The source or the origin could be anything. But once it enters your production process, it gets generalized. For instance, your transportation cost, it impacts each and every manufacturing activity and service. So it will increase the retail prices of most of the goods and services. But if they ignore it, and they remain in liquidity surplus mode, or what they call as accommodative mode, actually it will lead to inflation rising at a galloping, accelerating pace, which is not desirable at all. It will lead to more disruption. Today, just I'll give you an example. We say that inflation is rising, this and that, but still, when you go to marketplaces, you'll find many people desirous to buy commodities at that higher prices, because they have a higher consumer surplus. Lot of middle class and upper middle class people, rich people, have made huge gains during the pandemic from stock market, the investments, etc. And they have huge consumer surplus and purchasing power. Now, if Reserve Bank of India doesn't control demand coming from such people, it will impact everybody. So point is that you have to look at it as an action whose impact will be felt not immediately, but in the next 2-3 quarters, because monetary policy always acts with a lag.
Now, once we have been talking about it, and you started this interview with that point that this was more like expected, But wouldn't an April rate rise been a better thing? Because this seems like a missed opportunity when the market was actually expecting a rate hike at that point of time.
I think you should say February, because in April they acted. As I said, they introduced SDF and they set the SDF rate 40 bips higher than that. In February, they were completely silent on inflation management. But and that time we had divergence also, because some of the Monetary Policy Committee members, they were of the opinion that Reserve Bank of India should move to neutral stance from accommodative.
Yes.
But I look at it differently, because I feel there was too much pressure on Reserve Bank of India because of this massive disruption created by pandemic. And you see private sector's consumption spending as well as investment spending is still subdued. So whatever stimulus economy is receiving, it is entirely coming from the public sector. And government is facilitating that by increased market borrowings. Yes. So Reserve Bank of India also wanted to see that government gets funds at reasonable rates so that the stimulus will continue. So you see, people will criticize from both the sides. But point is that we have to acknowledge that the economic disruption caused by the pandemic was huge. So that was the need of the hour. And why just you see the experience of global central banks. So nobody in this kind of situation wants to strictly follow any rule-based framework. They would all like to go with the flow and remain data driven, because any kind of forecasting also, to tell you honestly, is ineffective when there is so much of economic uncertainty in the broader environment.
I understand that. Now, I was reading a recent paper by Rakesh Mohan and Parthare, which shows that regulatory forbearance was a significant reason for loans turning into NPAs. Are we falling into a similar trap with MSME credit, given that there has been a forbearance there as well?
See, that possibility cannot be ruled out, because both Dr. Mohan as well as Dr. Parthare, they have seen, many business cycle upturns, downturns, and they are very experienced people. So when they are putting forth a research finding, it has a lot of credibility. But point is that, everything depends on the credit underwriting standards of banks and NBFCs, and how they make the selection. Whenever there is a regulatory forbearance, the chances of adverse selection are very high. Yeah. I will not deny that. But it's not the case that MSMEs in all sectors are doing badly. For instance, during the phase of low growth, we have seen that Indian exports have done exceedingly well. Within that, food products, agricultural commodities, textile exports have done well. So if somebody has focused on MSME units, which have been providing back-end support to these activities, I think they will not have cash crunch or cash flow problems. I will not say that everybody will be trapped with a huge, influx of NPAs. But yes, that possibility cannot be ruled out, because when there is too much of push to lend to a particular sector, definitely, delinquencies go up, and economic growth is still quite fragile. And MSME is the segment which takes the brunt of it. So that possibility cannot be ruled out.
Talking about brunt, this is very interesting. Do you think NBFCs will bear the brunt of rate rises more than banks?
Oh, definitely, because NBFCs, have to borrow from markets to undertake lending. And they don't have this advantage of CASA deposits, current and saving bank deposits. So their cost of funds is very high. So because of CRR, if the cost of funds has gone up for banks, they are going to pass it on to NBFCs, because NBFCs borrow funds from banks or markets. And we have seen most of the banks have raised their rates. So NBFCs that have planned their liability franchise well, where they have good economic research divisions, which have warn them ahead of the curve
Yes.
that these kind of actions are coming. So you make a appropriate move towards long-term funds now itself, raise long-term funds ahead of the curve, so that when interest rates start rising, you don't have to raise funds at that time. So NBFCs which have planned their operations well, they will be in a better position. But NBFCs which have not planned their liabilities franchise well, they will certainly face a huge brunt of this rate hikes.
Thank you. Thanks for coming on the show. It was great having you, and we hope to have you back again soon. Thank you.
Thank you. It was a pleasure talking to you.
Same here. Rupa believes that given that foreign prices will have had a pass-through to domestic prices, increasing rates was inevitable. Moreover, she points out that NBFCs which have had sound financial planning would not be impacted much by RBI hikes. That's all for this week. We'll be back next Thursday at 11 a.m. with more news and insights. Do subscribe to our YouTube channel, and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.